In this video, I'm going to tell you how to help your kids from getting outbid on homes. Hey, I'm Kevin Hutty. Welcome to the Hutty Buddy channel, where I give you a ton of useful information and tips about real estate. Homes for sale in the US have been receiving 5 offers on average, and a quarter of the transactions end up being all cash deals. Not surprisingly, the younger buyers continue to lose out to those who don't need financing or have much larger down payments. Those who are fortunate enough to have relatives that have the means to help may be appealing to them now more than ever before. But what's the safest, most effective way to provide financial assistance? Generous parents or grandparents need to keep in mind the potential tax implications, along with the possible negative effects on their retirement savings and credit profile. Those who trust their adult children are comfortable providing funds directly to them should either give them the cash as a gift or set up a loan. Those who are more worried and want more oversight may consider other options, such as creating a limited liability company to purchase the house. Those come with some important caveats. Let's start with the parents who are fine with giving the money outright or setting up a simple loan agreement. If you just want to transfer the money and you don't expect to get paid back, and don't forget about the IRS's annual limit. An individual can give up to $15,000 a year or $30,000 for married couples before they have to file a gift tax return. If they give more than that, which many commonly do, to cover the cost of a big down payment or sometimes the whole house, they don't necessarily owe taxes, but they do need to report it. Those looking to make very generous gifts without filing an extra return can do things like give an extra $15,000 to a child's spouse, or try to time it so they give part of it in December and the other part in January. Family members who prefer to lend money for a home would be wise to set up a promissory note establishing terms such as duration and interest. Remember, if you don't charge interest or you charge lower than the federal level, you'll have to worry about imputed income interest on your taxes. If you want to make the money a gift, you should structure it as a loan and then forgive the amount of the gift limit each year. And that way, they don't have to file gift tax returns. More cautious parents may be attracted to the benefits of forming an LLC to purchase a home. The entity offers protection by separating the parents' personal assets if anything goes wrong, such as an accident at the house, and it can provide anonymity if that's something they're looking for. In addition, detailed stipulations can be included in the LLC's operating agreement to perhaps minimize involvement by a child's spouse they don't like, for example, or specify certain things happen once a child hits a specific age. When it comes to taxes, however, the LLC may not be ideal. It has to be structured a certain way for homeowners to be able to deduct certain things like property tax. And having an LLC own the home means it's unlikely the home will qualify for the capital gains exemption when it comes time to sell. The primary residence exemption allows taxpayers to avoid paying capital gains tax on up to $250,000 for singles or $500,000 for married couples. Also, if in the future you or your child decide to tap into the equity of the home, or let's say a home equity line of credit for renovation, it's much more expensive and difficult to do when the home is in an LLC. There also may be extra forms to contend with, additional title and homeowners insurance to purchase, and annual fees in some states. LLCs tend to be governed by state rule, which can vary a lot, so be sure to know what those requirements are. Beyond an LLC, the most involved role a parent can play is to be a co-signer on the mortgage, if the lender will allow it. But that comes with the biggest dangers, many of which are known but are worth repeating. If a child has an unforeseen job loss and misses a payment, the parent's credit could suffer. Likewise, their income and assets could be at risk if their child defaults. That's not something parents should deal with near or in retirement. Hit that thumbs up if you enjoyed today's video. Call me if you're thinking about buying or selling in the greater Sacramento area. And don't forget to subscribe so I can update you on my new videos.